Welcome to the Deep Dive. This is where we try to cut through all the noise, the daily news churn, and really focus on the strategic signal, the stuff that matters long term. Today, we're doing a deep dive into Enbridge Inc. That's ticker ENB. They just released their Q3 2025 financial results.
And our goal here really is to help you look beyond maybe the immediate market reaction. This quarter, it's actually a perfect case study. You had a company miss a headline number.
Right.
But, arguably win the longer strategic narrative. We need to figure out why investors seemed okay with that, why they bought into the future story.
Okay, yeah, let's unpack that tension straight away, because those initial numbers, they definitely raise some eyebrows. GAAP earnings per share, EPS, that was $30.30, down quite a bit year over year.
Significantly.
And the adjusted EPS, the number analysts often focus on $C.46, that missed the consensus, which was $C.51. Normally that sends the stock down.
It normally does. And look, it was a speed bump, absolutely. But I think that EPS miss, it wasn't entirely unexpected. Management was pretty upfront about it.
Okay.
It was mainly driven by, higher financing costs and also depreciation.
Yeah.
And those were tied directly to the big U.S. gas utility acquisitions they just closed.
Ah, right, those costs landing.
Exactly. You get those fixed costs hitting the books hard in Q3, which, let's face it, is usually a seasonally softer quarter for utilities anyway. So that's the financial drag you saw.
But then, like you said, the operational side told a completely different story. Management immediately pointed to a record Q3 adjusted EBITDA. See, $4.27 billion.
Nailed it. And that's up, about $70 million compared to last year?
Yeah.
So this is where you see that divergence. The accounting headline looks weak, but the operational reality, the actual cash flow health measured by EBITDA, was strong.
So what drove that EBITDA then?
It was fueled by getting a full quarter of contributions from those new U.S. gas utilities, finally seeing them contribute fully, plus pretty solid underlying organic growth, especially in their gas transmission segment.
Got it.
So, the market saw the EPS drag, sure, but it seems like they quickly recognized that underlying operational muscle.
Which explains the stock reaction, right? It actually closed up 1.77% on the day. That's a pretty strong vote of confidence from investors.
It is. It signals comfort with the overall plan.
Okay, what about distributable cash flow? DCF. That's the metric that ultimately feeds the dividend, which is key for Enbridge investors.
Right. DCF was essentially flat year over year, $2.57 billion. But crucially, management sounded very confident about hitting their full-year targets. They reaffirmed the 2025 adjusted EBITDA guidance.
The C19.4 to C20 billion range.
Exactly. And they actually expect to land in the upper half of that range, so operationally strong through year-end.
Okay, stability confirmed there.
Yeah.
But they did tweak the DCF per share outlook just a bit, didn't they?
They did clarify that, yes. They now expect DCF per share to land near the midpoint of their C$5.50 to C$5.90 range.
And the reason?
Simple explanation, really. Higher interest rates sticking around, specifically impacting their U.S. dollar debt. It's an external pressure, not some internal execution fumble.
Makes sense. And the balance sheet. The foundation for all this, how's the leverage looking?
Very stable. Rock solid, actually. Their main leverage metric, net debt to adjusted EBITDA, stayed right at 4.8 times.
Which is comfortably inside their target range.
Exactly. They aim for 4.5x to 5.0x. Staying there is super important. It secures their investment-grade credit rating, first off, and it ensures they have the financial firepower, the dry powder to fund all these growth projects we need to talk about.
Without having to issue a ton of new shares.
Precisely. It all ties back to that low-risk, utility-like model they emphasize. Over 95% investment-grade customers, almost no direct commodity price exposure. That's what lets them execute. Oh, and 30 straight years of dividend growth helps build confidence, too.
Okay, so that stable foundation, it's the launch pad for, I think, the real headline from this quarter, the sheer size of their secured capital program. They greenlit, $3 billion in new projects just in Q3.
That's right, $3 billion. And that pushed their total secured backlog to a massive $35 billion.
$35 billion, wow.
Yeah, that $35 billion backlog, that's the strategic signal. Management kept talking about winning the plan this quarter. And that plan is diverse. It means they've basically locked in growth for the next 5 to 7 years, which helps insulate them quite a bit from a wider economic ups and downs.
Okay, where is that money going? Let's start with the traditional backbone, liquids pipelines. Heavy oil egress.
Right. Well, first off, mainline volumes were strong, a Q3 record, actually, 3.1 million barrels per day.
Is that just good operations, or does it signal something bigger about demand for Canadian heavy crude?
I think it shows that the need for Canadian egress getting that oil to market is still incredibly robust. Demand is there. But Enbridge's focus now, it isn't really on building giant new pipelines from scratch. It's more about efficiency. It's about mainline optimization, MLO, basically squeezing more barrels through the pipes they already own. That's smart because it minimizes the regulatory headaches and, frankly, the capital cost.
And they gave more detail on that MLO plan this quarter. We knew about phase one already, 150,000 barrels per day of new capacity. FID, the final investment decision, expected this quarter, aiming for service in 2027.
Yes, but here's the kicker, the new piece. They expanded the scope of MLO Phase 2. They're now aiming for another 250,000 barrels per day on top of Phase 1.
Wow, okay. How?
The key is leveraging existing connections. Specifically, they plan to use available capacity on the Dakota Access Pipeline, DAPL.
Interesting.
Yeah. So you add Phase 1 and the upsize Phase 2 together. You're looking at close to 500,000 barrels per day, 500 kilobpd2 of new capacity coming online around 2027, 2028, mostly just by optimizing.
500,000 barrels just by tweaking the existing system. That's pretty clever capital allocation.
It really is. Low cost, high return potential.
Okay, let's pivot. If liquids is about optimizing, the gas transmission and storage segment, GTM, seems to be all about capturing these huge macro trends. LNG exports, power demand.
Absolutely. Their strategy there is laser focused on the U.S. Gulf Coast LNG build-out. It's undeniable. Look at the projects they sanctioned this quarter. Short cycle stuff, high return gas storage expansions.
Like Egan and Moss Bluff.
Exactly. Egan adds 16 BCF billion cubic feet, and Moss Bluff adds another 7 BCF.
So that's 23 BCF of new storage capacity right near the big LNG hubs on the Gulf Coast.
And remember, they also have the Aiken Creek expansion underway. Add it all up, Enbridge is set to bring online over 60 BCF of new storage capacity.
Which is perfectly timed for.
Perfectly timed to capture demand from the, over 17 BCF per day of new LNG export capacity expected to come online by 2030. It's a massive wave, and they're building the infrastructure to handle it.
That seems like smart strategic positioning. You need that storage buffer for the LNG facilities.
You absolutely do. It balances the system. But they also showed some geographical diversity, sanctioning the Canyon System connection for BP's big deepwater Tiber development.
Right, in the Gulf.
And also the AGT enhancement project up in the U.S. Northeast. That one's designed to help reduce that crazy winter price volatility you see up there sometimes.
Okay, good mix. Now, I really want to zoom in on the gas distribution and power side. Because this data center theme, it seems to be picking up speed even faster than people thought.
Oh, it's the big upside surprise, isn't it? In what's usually seen as a kind of, sleepy utility business.
Right.
They did get some good standard utility news, positive rate case settlements in North Carolina and Utah, locking in decent returns. But yeah, the data center opportunity, it could be transformational for that segment.
How big are we talking?
Management said they've identified over 50 potential projects. And get this, the potential demand from those projects could be up to 5 BCF per day.
5 BCF a day. Just for data centers. That's enormous gas demand.
It's staggering. And the key thing is, it's not just theoretical potential. They said nearly 1 BCF per day of that is already secured.
Wow. Mostly where?
Mostly in key growth areas like Ohio and Utah, where this trend is really accelerating. This isn't your typical slow growth residential utility demand. This is large scale, high load, locked in demand. And it's driving the need for reliable power infrastructure fast.
And presumably that feeds right into their renewable power segment, too.
It does. It connects nicely. They're moving forward with about 1.4 gigawatts of solar projects through 2027. And significantly, those projects are backed by agreements with big tech firms. They mentioned Meta and Amazon by name.
So they're providing the gas pipelines, the local distribution, and the renewable power solutions. Kind of a full package deal.
It's a holistic approach, covering multiple angles of the energy needs for these massive new loads.
Okay, one more piece of this diversification story. Low carbon investments. They sanctioned their first big commercial-scale carbon capture and sequestration project, Pelican CO2 Hub in Louisiana.
Yeah, this is a pretty significant step. It's a partnership with Occidental, or Oxy. It's underpinned by a long-term 25-year contract to sequester about 2.3 million tons of CO2 every year.
But is it financially viable? That's always the question with these projects.
That's the critical insight here. Management was really clear. The financial returns they're targeting for Pelican are expected to be competitive with, or maybe even better than, their non-mainline liquids pipeline projects.
So no sacrificing returns just for green credentials.
Exactly. They stress capital discipline. These projects have to earn their keep, stand on their own financially.
Okay, that focus on returns brings us to maybe the core investor question. Can they actually execute this massive $35 billion plan without overstretching the balance sheet or having inflation erode the project returns?
Yeah, that was definitely a central theme management wanted to address. They expressed strong confidence in maintaining their C9 to C10 billion dollars annual growth investment capacity.
And the key is the diversity and timing.
Precisely. Because that C$35 billion backlog is spread across 4 different business units, liquids, GTM, gas distribution, renewables, and it's staggered over a 5 to 7 year timeline. They avoid that high plateau problem.
Where too many huge projects hit completion risk all at once.
Right. They can sequence the capital spending much more efficiently, manage the risk better.
And what about regulatory risk? That's always been a shadow hanging over midstream companies.
Yeah.
Any signs of improvement there?
Actually, yes. A bit of positive news. They specifically highlighted getting that crucial U.S. Army Corps permit in late October for the Line 5 segment reroute up in Wisconsin.
It's been a long-running saga.
It has. Getting that permit removes a major regulatory overhang for a really core asset. It provides the kind of long-term operational certainty that investors really value. So yes, some signs of de-risking there.
Okay, so if the operational plan looks solid and somewhat de-risked, let's circle back quickly to the financials. The long-term target is still that 5% compound annual growth rate, PCAR, for both EBITDA and DCF per share through the end of the decade.
Correct.
But you mentioned earlier they diverged a bit this quarter, with DCF per share lagging slightly due to interest costs. Why do they expect those two growth rates to converge again later?
The main reason for the current divergence, besides interest rates, is cash taxes. DCF has been taking a bit of a hit because they've had higher cash tax payments recently, especially in the U.S.
Okay.
But management projects that, as we move further into the decade, those cash taxes are expected to plateau, to level off.
And once that happens,
the DCF per share growth rate should naturally catch up and realign with the EBITDA growth rate. The underlying operational engine and the cash flow available to shareholders should move back in sync.
got it. Okay, that brings us to our final segment. This is not financial advice, where we cook up a high conviction, maybe slightly outrageous hedge fund style trade idea based on something we think the market might be overlooking from the call.
Right. And the idea today, it really hinges on the market fully appreciating the successful execution of that C$35 billion backlog, and maybe, more importantly, the shift in Enbridge's business mix, moving away from just being seen as a sleepy utility.
Towards being critical growth infrastructure.
Exactly.
Okay, lay it on us. The pitch.
The pitch is go long Enbridge, ENB, and simultaneously go short a broad, low-volatility U.S. utility ETF. Think something that tracks the big traditional power and gas utilities.
Okay, long EMB, short the slow-moving utility sector. What's the core thesis?
It's pretty simple, really. You're buying Enbridge because you believe in its specialized targeted growth drivers, and you're betting against the general, slower, more traditional utility sector at the same time.
Because those traditional utilities are mostly stuck with regulated rate-based returns.
Fundamentally, yes. Their growth is often capped by regulators. Enbridge, we argue, is becoming structurally different. It's integrating its assets directly into these very specific, very high-demand sectors.
Like the massive LNG export infrastructure.
Yeah.
Specialized gas storage needed for that.
Right.
And maybe the biggest kicker, that accelerating high-growth data center power demand.
Absolutely. That C$35 billion backlog, it's specifically designed to deliver superior growth that targeted 5% CAGR compared to the maybe 2-3% growth you typically see from a conventional utility basket.
So the bet is the market eventually wakes up to this.
The bet is the market eventually re-rates ENB's stock, gives it a higher multiple to reflect its faster, more dynamic growth profile, especially once those big MLO and GTM projects really start spitting out cash flow in 2027 and 2028. You're essentially trading a perceived regulated utility for what's becoming an infrastructure growth company.
Okay, interesting angle. Let's quickly recap the main highlights from the call then. Enbridge delivered that record Q3 adjusted EBITDA.
Despite the EPS miss.
Right. Maintained stability on the balance sheet, kept leverage in check,
Crucial.
and provided a huge amount of clarity on its growth story beyond 2026, sanctioning C $3 billion in new projects, pushing that secured backlog up to C $35 billion.
And detailing that upsized MLO Phase 2 expansion, potentially adding nearly 500,000 barrels of liquids capacity.
The overall message seems to be the operational plan is strong, it's diverse, and it's getting increasingly de-risked through regulatory wins and disciplined capital spending.
I think that sums it up well. The execution is key now.
All right, let's end with a final provocative thought for you to chew on. They detailed MLO Phase 1 and Phase 2, getting them close to 500,000 barrels per day of optimized capacity. But given the seemingly improving policy support, particularly in Canada, and just the sheer amount of existing pipeline infrastructure brownfield capacity that Enbridge already owns, how quickly could they potentially advance an MLO Phase 3 or Phase 4? Could they unlock even more capacity beyond that current 500,000 barrel forecast? That feels like a potential unpriced upside.
That's a great question, an unpriced call option, perhaps. And maybe tying that back to the data center boom, think about the ripple effects. That accelerating power demand isn't just about needing more natural gas or solar panels. Think about all the other commodity inputs needed. Steel, concrete, copper, industrial materials. Building out that entire new generation and grid ecosystem requires an enormous secondary infrastructure boom. That's another huge trend worth keeping a very close eye on.